Hello, welcome to our conversation on financial reporting. The focus of this session is understanding cash flows and revisiting Ind AS 7. We know that cash is not equal to profit because cash is receipts minus payment, whereas profit is incomes minus expenses. Moreover, profit is calculated using the accrual concept and matching concept. Profit is accrual, and profit depends on the measurement assumptions regarding several items like depreciation, amortization, cost of goods sold, and lease rent. Whereas cash is actual cash flows. Cash is actual, profit is accrual. For example, we can have a look at the companies, the examples. We can see that balance sheet of this company, Grasim's. No, we can see the profit of the company is 3,846 crore in June 26. In March 26, it is 3,684 crore. This is the profit for the period. Whereas the cash on that at the end of that period is around 6,000 crores, 7,000 crore. So we can see that profit is not equal to cash. That's the case with all the companies because of this conceptual calculation. Cash is calculated by deducting payments from receipts. Profit is calculated by deducting expenses from incomes. But it's important to understand the calculation of cash in hand. The calculation of cash in hand is governed by Ind AS 7. And cash in hand, according to Ind AS 7, can be calculated as opening cash in hand plus minus the cash from operations, cash from financing, and cash from investment activities. So Ind AS 7 is very clear that you need to classify the cash flows on the basis of the decisions, operations, investment, and financing activity. But our focus within that is cash from operations. Cash from operations, as per the Ind AS 7, can be derived by using direct method or indirect method. In case of direct method, CFO is operating receipts minus operating payments. Whereas in case of indirect method, CFO is adjusted profit. And here I'm using adjusted PAT. So if PAT, the indirect method answers this question, why is CFO not same as PAT? There is every possibilities the companies may have positive PAT but negative CFO or vice versa. We can have a look at it. In case of the Grasim's Industries Limited, the cash from operations is negative for last 4 years. We can see that it is negative 12,000 crore, negative 10,000 crore, negative 17,000 crore, negative 17,800 crore. Whereas during the same period, the profit of the company has been positive 9,000, 7,000, 10,000 crore, and 11,000 crore. And this is not just the case with Grasim's. We can also see Cochin Shipyard, another listed company. The last 3 years, negative CFO. Whereas the profits, the company has been consistently earning profit. Whereas a company like Infosys, we can see that cash from operations is consistently positive. That means the company is generating cash from operation, whereas the shipyard, Cochin shipyard, the cash from operations are negative. Grasim's cash from operation is negative. That means these companies are not able to generate sufficient cash from operation. So why is cash from operation not same as profit after tax or profit in general? As we mentioned, profit is as per the accrual, cash is actual. So for deriving cash from operation, from the PAT, we make adjustments. Adjustments for non-cash items, non-operating items, and the credit item, which is also called the changes in operating current assets and current liabilities. So profit adjusted for non-cash, non-operating, and the credit item will give us the cash from operation. Cash from operation is the indicator of the fundamental strength of the company. A company is expected to generate cash from operation to sustain. Maybe in the early days of a business, CFO may be negative because the business might have started and it's possible that the operations are not generating sufficient cash flows. But a consistent CFO negative will create problem. Let us understand this with a small numerical problem. Okay. So we can see that this is a new company, opening balance sheet is 0, and this is the year the business has started. The profit is 311,000, whereas cash in hand is 31,000. Why is cash not same as profit? Because profit is incomes minus expenses. The cash is receipts minus payment. We can see that every receipt is not an income. Every payment is not an expense. But let us understand this cash in hand more clearly by using the Ind AS 7. Ind AS 7 says this cash flows should be classified on the basis of operations, on the basis of financing, and on the basis of investment. So cash in hand is equal to opening cash in hand plus minus CFO, CFF, and CFI. It's important and interesting to observe that cash from operations is negative here. Despite the fact that the company is having profit, there is a positive profit, but negative CFO. Why is CFO negative when the company is having a profit of 311,000? The significant part of the reason for negative CFO is the credit sales. We can see that the company has made a sales of 800,000 but has received only 200,000. Therefore, there is a huge amount of receivable sitting on the balance sheet. And now this understanding will become clear when we find CFO by using indirect method. As we saw here, CFO indirect method is PAT plus minus adjustments for non-cash items, non-operating items, and changes in operating current assets and current liabilities. So PAT is 315,000, right? PAT is 315,000. Now let us close this. We don't want to, let us focus on indirect method of deriving the CFO. So PAT is 315,000. But there are non-cash items like depreciation, And to that extent of 20,000, PAT has been reduced, whereas that is a non-cash item. So to derive CFO, we have to add back. In this example, there is no amortization, but there is non-operating items like interest. Interest, as per Ind AS 6(7), it is treated as a financing cash flow, not as operating cash flow. So it has been deducted while computing profit. So therefore, we adjust it by adding it back. Then comes the changes in operating current assets and current liabilities, which are the reflections of the credit sales, credit purchases, credit expenses. In this case, there is a big change in the receivables. We can see that the receivables have gone up from 0 to 600. What does that mean? The company did not collect money to that extent, or to that extent, there is a credit sales. There is no other change in the other current assets, no change in the stock. That means whatever has been purchased has been sold. No change in creditors. That means the goods have been either purchased on for cash, or even if you purchase on credit, by the end of the year you paid it off. There is no change in salary payable. That means entire salary has been paid off during the period. So observe this, a big chunk of the sales is on credit. So the change in the current assets and current liabilities, particularly operating current assets and operating current liabilities, is a reflection of credit transaction. The changes, the non-operating items is a classification of those items which are not treated as operating as per Ind AS 7, like interest, and non-cash items like depreciation and amortization. So CFO is not same as PAT because of non-cash, because of non-operating, and because of changes in the current assets. Just observe this changes in this case receivables. Let us assume that the entire entire sales will be collected in cash. Suppose entire sales is collected in cash. If entire sales is collected in cash, CFO becomes profit positive. CFO becomes positive because the entire sales is for cash. So it's important for us to understand the companies, to observe a company. Though it is important to see the profit, it is equally important to observe the operating cash flows, financing cash flows, and investment cash flows. Take the case of Infosys. Has been consistently generating cash from operations. What are they doing with that cash? That may be a question. And that the answer to that question you will not get when you see the income statement, but it's visible in the cash flow statement. We can see that the negative CFF is responsible for, or reflects rather, the use of the cash flows. So what is Infosys doing with negative? Why the cash from financing negative? And that too consistently negative for last 10 years. This negative CFF of Infosys is because of the payment of the dividend, or sometime maybe because of the buyback of shares. So it's always important to observe what is the change in the cash flow, why the cash flows are, the nature of the cash flows. Is the company generating cash from business? If yes, what are they doing with that cash? So that brings us to the end of our discussion, that it is important for us to understand cash is not equal to profit. And it's always important to understand the cash flows as per the Ind AS 7. Thank you very much.